me share my screen. Okay, so Xavier, let me ask you. Okay, uh, Xavier, what do you see on the screen?
What are bond ratings?
Good, thank you. All right, so let's continue on with this topic that we had begun before. So, what are bond ratings? Bond ratings are rate the credit worthiness of the company that is issuing the bond, of the company that is issuing the bond, not the investor, not the investor. This is the company that's issuing the bond. So it's derived through fundamental credit analysis and it expressed in a symbol system, double A, triple A, double B, so on and so forth, so on. By definition, what is credit worthiness? The ability to pay the amount on time. On time is critical too. So, are you going to make required payments on time? Okay, it's not going to tell you when the company is going to default. If it's going to default, bond ratings are not buy and sell recommendations. They're not buy and sell recommendations. So how do governments go on there and go out there and handle these bond ratings? And I shouldn't say governments, but any type of entity that issues a bond. Okay? You have all these different types of factors that a company must consider when they're going out there and managing their bond risks. Okay? So, who determines bond ratings? You've heard of the bond ratings all before, but they're done by independent rating agencies. I think there's many companies that give bond ratings, but the three that I only know of are the real big ones. One is called Fitch, one is called Moody's, and one is called Standard & Poor's or S&P. So these three companies give bond ratings. And so right here, okay, I have this kind of a fuzzy slide here, a little bit fuzzy. And this is then the bond ratings by Moody's and S&P. So you see here then for S&P, AAA is capital A, capital A, capital A. Okay? And for Moody's, it's capital A, and little a. So when I see, because I'm familiar with this, and I've been dealing with this for such a long time, when I see just the differences in the capital A versus the lowercase a, I know that we're dealing with Moody's and S&P, the difference between those two. Okay? And now look at this. You have double A plus, double A minus. That's S&P. Look at the way Moody's does it. Capital A, 1. Capital A, 2. Capital A, 3. capital A, little a 3 corresponds to capital A minus on S&P. So you can see that they do it a little bit differently. And this is what always gets me. I never did understand this. So we know how Moody's is going to do it. It's just going to be all capital letters, right? But what about, I'm sorry, S&P, all going to be all capital letters. But what about Moody's? What about Moody's, right? How do they do triple B? Capital B, little a, 1. That's for triple B plus. Capital B, little a, 2. That's just for triple B. How come they don't do capital B, little b, little b? Who knows? Who knows? Okay. But I just know I can recognize a ratings from Standard & Poor's versus Moody's just by looking at the letters. There's another one too, Fitch. So I think I have Fitch somewhere. I think I have to go down a little bit and find Fitch. Okay. And then right here, the lowest you can get is D. The lowest you can get is D. It means it's in default. So it means that the bond has been missing payments. So it's in default. It's in default. Okay. D is only an S&P rating. There's no equivalent default rating for Moody's. There's no equivalent default ratings for Moody's. Now, I know what your next question is going to be. I know what your next question is. So, S&P, I'm just making this up, gives a company a AA rating. What will Moody's probably give it? Can Moody's give it a C rating? Probably not. Probably not. Okay? If S&P gives a company a AA plus, probably the lowest that Moody's will give it is a AA3. Same general category. It's not going to be wildly divergent between the two companies. S&P isn't going to give it a AAA. Moody's gives it a C. Because basically they use the same ratios to grade the bonds. The same ratios to grade the bonds. You're not going to see a big difference between them. Okay. Oh, here we go. Here we go. So, okay. So you see Moody's and S&P. This one is better because it gives the all the ratings. Okay. This is a good one too. Because here comes Fitch. Here comes Fitch. Okay. So how would I go out there and say who's the biggest and the best? Moody's, S&P probably are the most reputable. However, Fitch, very good also. Very good also. So if you were looking at the recommendations for Moody's, S&P, and Fitch, these three are the gold standards. There are other companies that do bond ratings also, but they just don't have the same clout that Moody's, S&P, and Fitch has. These three are the big three when it comes to bond ratings. Okay, and kind of funny, right? Look at for the C's, triple C's, double C's, single C's. Okay, you could see right here that Fitch They just have triple C. They don't, what happened to double C and C? I don't know. Now look at Fitch. Look at how they rate the defaults. Yeah, that's why I remember we pick Fitch a lot. Because Fitch gives you a breakdown on the default risk, the Ds. Whereas S&P, this could be too broad. And remember that Moody's doesn't even give you a rating. That shouldn't be an I there. That should be a nothing. Okay? And you could see here then all of these. Oh, I don't know about this one. I don't know about this slide. I don't know about this slide. I think this slide is better. This is the default. Because this one says that double C and CC minus are in default. I don't know if that's true. I don't know if that's true. I got to check this slide. Okay? But in terms of investment grade, triple B and above are investment grade. Many of your pension funds, some companies, their policy is to invest in investment grade bonds and above. Okay? Why can't, if there's a potential to make money in junk bonds, then why can't these pension funds invest in junk bonds? Because the government doesn't want you messing around with people's retirement money. Maybe these pension funds aren't earning a lot of money, but the probability that they lose money is also very, very low. Again, can an investor make money in junk bonds? Yeah, a whole bunch. A whole bunch. Okay? But the lower the investment, the higher the probability that you lose money. Here we go back to this. Remember we did this stuff before? Finding the price of the bond? Finding the price of the bond? So in this particular case then, we have a bond that has a coupon rate of 3%, a face value of 1,000. These will never change. These will never change. The interest rate, this should really read the market interest rate. These are the wild cards. These change all the time. So based off this 3% coupon rate and a future value of 1,000, this what did we call this face value before? Par value. That's how much the investor will receive when the bond matures. So again, in year one, 3% times 1,000, $30. Year two, 3% times 1,000, 30, all the way down. Until year 10, how much will the investor receive? The investor will receive 1,030, the par value, plus the annual interest rate, annual interest revenue. Okay? So when the market interest rate is 3%, all of this is equivalent to a 3% rate of return. When the market interest rate is 3.5%, the price of the bond will be $958.42. Remember, these won't change. So if the price of the bond is $958.42, all of this is equivalent to a 3.5% rate of return. Finally, If the market interest rate is 4%, the price of the bond will be equal to $918.89, which makes all of this equal to a 4% rate of return. Remember that the company is contractually obligated to make this payment. Therefore, the price changes to make these payments equivalent to the market interest rate. One more time. The company is contractually obligated to paying this set of cash flows. For the investor, this is their cash inflows. The price of the bond will change so that these cash flows are equivalent to this rate of return. The cash flows are equivalent to this rate of return. Okay, so you see here then on this chart, good chart, they're looking at the relationship between the market price, this is called yield to maturity, the coupon rate, and the life of the bond. The life of the bond. What does this tell you, basically? What does this tell you? Especially looking at these two factors. The longer the life of the bond, the more volatile the bond price is. The longer the price of the bond, the more volatile the bond price is. What's the next step? Measuring this volatility. Measuring this volatility. The measurement of this volatility is commonly called a bond duration. It's a measure of the bond's price sensitivity to interest rates. It's a measure of the bond's price sensitivity to interest rates. It's measured in units of time. The more distant a cash flow is, the more sensitive that cash flow is to interest rates. The farther along a cash flow is in the future, the more sensitive it will be to interest rates. What is bond duration? What is bond duration? You remember this from your economics class. This is called an elasticity. Remember that from your economics class? An elasticity. How sensitive is something to a change in something else? How sensitive is something to a change in something else? And from your economics class, you might remember something called the price elasticity of demand. How much is the demand of a product affected by its price? How much is the demand of something affected by its price? Remember inelastic demand? The price can change a lot, but the demand for that item won't change much. What's the classic example of inelastic demand? Gasoline prices. When gasoline prices go up, usually the demand for gasoline doesn't go down by much because people need that gasoline. But That's getting off the track too much. What is duration? Duration is a measure of elasticity. So what is the duration of the bond? The sensitivity of a bond price to changes in the market interest rate. The coupon rate won't change. The sensitivity of a bond price to changes in interest rates. Okay. Remember elasticity in economics. If a bond has a duration of 8, what does that mean? If the interest rate changes by 1%, the bond price will change by 1% times 8, 8%. If the interest rate goes up by 1% and the duration is 8, the bond price will go down by 8%. If the interest rate goes down by 1%, the bond price will go up by 8%. That's why they show a picture of the teeter-totter here. When one goes down, when the bond price, when interest rates go down, bond prices go up. When interest rates go up, bond prices go down. Okay? It's always shown by the teeter-totter. When interest rates go up, bond prices go down. When interest rates go down, bond prices go up. Okay? And here, if we're measuring time, the longer the time, the greater the duration. Again, here comes the teeter-totter. Okay, again, here comes the teeter-totter. So, with more time involved, okay, and we have a duration of 2 years, or duration of 4 years. Remember, duration is always given as the number of years. When interest rates go up by 1%, because here it's price drops by 2%, but why does the price drop by 4% in this case? Because of the longer time frames involved. Because of the longer time frames involved. Okay? So all of the things being equal, the lower the coupon, the larger the duration. The longer the maturity, more time means more duration. The lower the yield, the larger the duration. Okay? And here we have some other formulas here. So again, based on the time, okay, what's called the fulcrum. Remember fulcrum if you remember fulcrum in physics, this thing at the point of the teeter-totter, okay, that's going to have an effect of the bond. Okay? And we're going to look at this, the duration of the bond. Okay. Here's the formula. The present value times the cash flow divided times the time divided by the market price of the bond. So the present value times the cash flow. This gives you the present value of the cash flow times the time. Okay. N is the number of periods, market price of the bond. So we're going to have to calculate the market price of the bond, then the duration. Okay, so here we go. Here we go. All right, let's make this bigger. Let me make this this part right here bigger so you could see this. And this is gonna finish this up for the night. Okay, yeah, this all this all this stuff we did already, right? So we're comfortable with this. So make this bigger. Let me make this bigger. So we've been talking about that duration. We've been talking about that duration. What does that mean then, right? What does that mean? Let's try an example. So we have here, we have a coupon interest rate of 6%. The market interest rate of 10%, 10%, maturity 3 years. And what we don't see here is we need a future value. So let me put that in here. So we have future value. Ah, ah, holy cow. We'll make this 1,000. The annual payments then will be equal to 6% times 1,000, 60, 60. And when the bond matures, you're going to receive at the maturity 1,060. The present value factor, remember the present value is equal to the present value factor is equal to, what's going on here? Okay. One, I should have set this at 10% based on the year, based off the year. Okay, so this is 10% at 1 year, 10% at 2 year, 10% at 3 years. 60 times 0.909, 54.54. 60 times 0.826, 49. 1060 times 0.75, 796. You add these together, that's going to give us a bond price of $900.53. $900 times 53 cents. Now, here comes two columns you haven't seen before. The next thing that you want to do is that you want to take this column, column F, is going to be equal to column E, these three, divided by the price. So we just calculated the price. 54 divided by 900, 0.06. 49 divided by 900, 0.055. 796 divided by 900, 0.88. 0.88. Now, column G is going to be equal to column F times column B. Well, I have it at column A. Yeah. It should, we'll set it at column A. Okay. One more time, I'm sorry. Column G is equal to column F times column A. Column G is equal to column F times column A. So for this one, this times 1 gives us this. For this one, this times 2 gives us 0.11. And in the last year, 0.88 times 3 gives us 2.65. 2.65. Add these together. The duration for this bond is equal to 2.82. The duration for this bond is equal to 2.82. That's kind of like a break-even number. That's 2.82 years. So, given the coupon interest rate at 6%, the market interest rate, the yield to maturity, 10%, 3 years, a future value equal to 1,000. Okay, what does this mean? We have a duration equal to 2.82. Don't forget the teeter-totter. Don't forget the teeter-totter now. When interest rates go up by 1%, the bond price will drop down by 2.82%. When interest rates go up by 1%, the bond price will drop by 2.82%. It works the other way also. When interest rates go down by 1%, the bond price will go up by 2.82%. Okay, and let me give you an extreme example to make the math easy for myself. Okay, so if interest rates drop by 10%, bond prices will go up by 28.24%. When interest rates go up by 10%, bond prices will drop by 28.24%. Too much of a spread, too much of a leap, but you get the point. You get the point. When interest rates go up, bond prices go down. We already knew that. We already knew that. But now this is being more specific. When interest rates go up by a certain amount, what do we expect the bond prices to drop by, and opposite? That's what duration buys you. It gives you an exact amount of the increase or decrease in bond prices. Any questions? Any questions?
So you're saying
Thank you,
now is a
Leslie.
good time to buy bonds?
No. Now is a bad time to buy bonds because I think the Federal Reserve just raised interest rates 0.25%. So when interest rates go up, bond prices go down.
Yeah, if you buy it low, doesn't that mean you're going to get it higher when interest rates go back down?
If interest rates go back down, But I think the Federal Reserve has
Okay.
announced that they're going to have about 3 or 4 interest rate increases. Yeah. So not right now. You may want to stay away from bonds right now. I'm going to stop
Got
recording.
it.